A month ago, I had the absolute pleasure of attending the Self-Directed IRA Summit 2017 and got to meet a number of fantastic people. Randy Luebke was among them. His presentation at the summit was something I absolutely wanted to share with everybody humanly possible. I've been in conversation with a number of RIAs and registered reps over the years, and Randy's ability to incorporate income-producing real estate into an overall financial structure is absolutely exceptional. Today we're going to cover the value of a fiduciary and especially why it's important to you as an investor, and then towards the end we're going to wrap up with how Randy's concept can be incorporated with direct source wealth. First, a couple of housekeeping items. There will be a couple of handouts available throughout the presentation. There should be a spot in your menu where you can see to get the handouts. If for any reason you can't get them, please feel free to email me directly at dave@directsourcewealth.com, and we'll be sure that you get a hand on them. Also, there's some questions tab that's in the menu and an open chat bar, and I'll be handling those on a second screen. So if you have questions along the way, we will open it up for Q&A afterwards, and we hope that y'all are as engaged as I was when I first met Randy. So without further ado, I am going to turn this over to Randy, and let's get this on the road.
Well, very good. Thank you for the introduction, Dave. Can you hear me clearly and you see my screen? I want to make sure that I'm not talking to a blank wall here.
I can hear you just fine.
All right, excellent. So thank you all for joining us here. I'm going to say this morning, I'm talking to you from beautiful Newport Beach, California, here in Southern California. I realize when you're dealing with the internet, we have a lot of different time zones going on here. But I will thank all of you for taking your time out to listen to our conversation today. And we're going to talk about some things that you're not generally going to hear in the traditional financial services industry or communications. And I was really excited when Dave said, Randy, would you like to talk to our group? Because I think what, again, we're going to share this morning is going to be unique and special. And Dave, just for your edification, some of the things we're going to share are brand new. I've never introduced them to anybody before, so this is special for your group in a lot of different ways. All right, let me make sure I get this thing rolling here. I have to do the disclaimer part of it, and I'm not going to read this whole thing, but I just want to make just the first 4 bullet points here. This is for educational purposes only today. There's no personal or investment advice that will be given out, and no recommendations are going to be made, and there's no financial products to be sold. This is an educational workshop, and I hope that's what you came here for, because you're going to get a lot of it. I want to stop a minute and talk a little bit about Lifetime Paradigm and myself and what we do. So Lifetime Paradigm essentially is an intellectual property company who's designed a number of unique and proprietary systems and strategies, and we provide real estate integrated and self-directed retirement planning, asset protection, estate planning, and tax planning to business owners, homeowners, and real estate investors. And I'm, judging by the business model of Direct Source Wealth, I'm sure that's what this audience is made up of. And when you take a look at this, what we do and who we talk with, it really makes us a very unique animal, if you will, and that's why Dave was so gracious in asking me to present to you today. A little bit about myself. I got a few credentials after my name too. I'm an investment advisor representative. I'm also what's called a registered financial consultant, a registered mortgage advisor, certified wealth protection planner, and a certified Medicaid planner. And of course, I'm the president of Lifetime Paradigm. Those are my credentials, but let me tell you a little bit about what I do. For the past 30 years, I've been in the financial services industry. I started out in the mortgage business. Today, I'm a life insurance agent, I'm a real estate broker, I'm a mortgage broker, I'm a securities advisor, and I'm an educator. And over the last 30 years, I've funded nearly $1 billion in home loans. I've helped scores of people with their retirement plans, and I've trained hundreds of other financial planners, attorneys, realtors, CPAs, stockbrokers, and insurance agents, teaching them how to become better stewards of their clients' money. So as a financial planner, my role is to create financial plans for my clients, roadmaps, to help get them what they want from life, which is typically, how do I find myself in a position where work is an option, where I'm financially independent. And as a wealth manager, it's helping them make the right decisions and choices with their investments along the way so they can realize that dream. So we do a lot of things in a lot of special ways, and one of the things we want to talk about to start out with here is advice. And I use these drawings, these little black and white drawings, because I think they tell a lot for how simple they are. You look at the drawing on the left, a typical traditional financial plan is really just a bunch of assumptions, and then you take that over a long period of time. And the problem with that is twofold, or multifold, I should say. The first one being accountability, because if I make a bunch of projections and give you a beautifully bound financial plan that's 300, 400, 500 pages long, whether I do it for free or charge a lot of money for it, what kind of accountability do we have to see that we can actually deliver on the promise of the financial plan, especially if the financial plan is all focused on selling maybe just stocks, bonds, and mutual funds, or maybe just selling life insurance products? Well, those are certainly things you want to include in a financial plan. In my mind, it shouldn't be the only things you should include. So if you look to the right, now I have the diagram of what we would call a good financial plan, which is we take a look at your money. When I mean your money, we're talking about all these different assets you have, including your income and your life. And where those two things come together in that little black line, that's where real financial planning advice comes from. So the question for you, or the question you need to ask yourself, is where do I find this? Where can I find somebody that can give me this good advice and not deliver just a traditional financial plan, but deliver a real financial plan that could really have an impact on your life? Well, recently there was a book published by Tony Robbins. He's published many, many books, of course, over the years. And this recent book is called Unshakable. And he talks about the role of a fiduciary. Now, he talks about this in his previous book as well, by the way. Tony's a real, game changer for the financial industry. And I think he hit the nail on the head in a number of different ways in both of his recent books. But this idea of fiduciary, this comes up often. What is a fiduciary? Why do I care about working with a fiduciary? And by the way, how do I know if I find one? How do I know if my current financial advisor is one? And so this, you're not going to read all this, and I'm not going to read all this either. But the fiduciary is a very big thing right now in Washington. There is the Department of Labor is trying to implement a rule that will force all advisors to become fiduciaries. Now, I'm going to pause for a minute, because most people, think of their advisor as somebody that, of course, is giving them good advice and in their best interest. And I'll explain a little bit more of that in the moment. But you should understand that the large majority of financial advisors out there work for broker-dealers and are not fiduciaries. And just the pieces I've highlighted from this Department of Labor article, they're trying to stop it. And this is their words: in sweeping legislation, if it's not stopped outright, it will automatically elevate all financial professionals who work in retirement plans to provide this standard. What's interesting here is they're like worried that somebody's going to hold them to the standard of fiduciary, because again, it will really put a bind on their business model. So, what is a fiduciary? Why should you care? How do you know? Well, it really boils down to this: the advice that you get from a fiduciary. Most people have heard the term suitability, and the counter to that is in your best interest. And this is the difference between a broker-dealer representative and an investment advisor, is that the advice we have to give as a fiduciary has to be in your best interest. Now this sounds, again, very counter to what people are used to thinking about. They go to their financial planner, they trust them, they're well-educated people, most of them, and they have licenses and degrees and certifications. Yet, and they would imagine that the advice that they would get would of course be in their best interest. That's what you go to them for. But the reality is, if they're not a fiduciary, they're really an employee of their broker-dealer, and as a result, they have to give advice that's in really the best interest of their broker-dealer. And the difference is, in the standard of care, suitability basically means, can you take the hit? In other words, if I were a broker-dealer representative, I could suggest that you purchase this, that, or the other thing, and it could truly be a bad investment. Not that they would do that intentionally, but it could be, and you would have no leg to stand on in terms of accountability, because they have met their obligation, which is if you can buy it and you can afford the loss, they're protected by the law, and the advice they're given is suitable for you. On the other hand, a fiduciary has to do what's in the best interest for you in terms of their advice. Now, are they perfect? Absolutely not. Do they always make the right, give the right advice and make the right suggestions? Of course they don't. But they have to try. That has to be their focus. And this is, kind of alarming to a lot of people. It certainly is an eye-awakener. I'm glad Tony Robbins wrote the book. That fiduciary is a big deal, that the industry is fighting it, and we'll have to see how it all shakes out. Right now it's on pause. Since we have our new president in place, they put it on pause for a while until they can sort out what they can do, because this is going to rock the business model of the bulk of advisors out there. As part of the download, and you'll see the download off in your control panel, you can download these 7 key questions, because this is what you want to be able to ask your advisor or any potential future advisor that you're going to work with. So I took this right out of Tony's book. Here's the, go through the questions. Are you a registered investment advisor? Correct answer is yes. And typical advisor is going to say, no, I'm not. They're not going to be an investment advisor. They're going to be a registered representative, of their broker-dealer, which is question number 2. Are you or your firm associated with a broker-dealer? It's another thing that people make a mistake. They say, I'm working with an RIA, Registered Investment Advisory, which is a company, but you have to ask them, is that advisory associated with a broker-dealer? Because if they are, they're in the same boat, their hands are tied. They have to sell you what the broker-dealer tells them to sell. Does the firm offer proprietary mutual funds? Do you receive any third-party compensation? What's your philosophy on investments? Just pause on that one for a minute. Most advisors can't beat the market, and that's the fact. Most advisors don't do as well as the market, which is why the ETFs, exchange-traded funds, S&P index funds, have become such a big thing. And Tony talks about those in his book. The typical advisor wants you to do buy and hold, which means you ride the downturns. This is the biggest problem with ETFs. Let me pause for a moment. ETFs, the most common one, of course, is the S&P 500. The S&P 500 is an index that represents the value of the top 500 stocks on the New York Stock Exchange. Those 500 companies represent 80% of the market capitalization of the New York Stock Exchange. So that is the market. And if you look at it statistically and own that ETF without paying advisory fees and just wrote it up and down, you would have done better than literally 95% or more of all the advisors out there just by owning the ETF itself. The problem is those downturns can be really big. If you were invested in the S&P 500 in 2008, 2009, you saw your 401k get cut in 2. And if you were investing back in 2000, 2001, 2002, when our dot-com bubble blew up, you could have seen your portfolio wiped out completely. So the downturns are tough to recover from. They can take a lot of time. Again, if you're in your 20s and 30s, you might have the time to do it, but if you're in your 40s, 50s, 60s, and certainly 70s or 80s, riding the downturns is not going to be a pleasant ride. What we recommend is using tactical managers and avoiding losses. The idea of avoiding losses as opposed, in other words, we want to hit a lot of singles and doubles and then avoid those strikeouts, because if we can get you on base often enough, you'll actually end up netting more money than you would if you had the big home runs with the buy and hold strategy. So number 5 is a real important point. You want to ask your advisor what's their philosophy. What are they going to do to get you out of the market before the market goes down and takes all your money away? What financial planning strategies does your firm offer? Income planning, asset protection, estate planning, tax planning, and more. This is a financial plan. We're going to go into this a little bit. You have to have a lot of different pieces, and what most financial advisors are in the business of is collecting assets. They want to put assets under management, which is fine. This is what they do. And they may even offer you a financial plan to do that, but they're really not looking at the whole picture. And then finally, where the money is going to be held. This is another kind of big deal. It's a huge deal. Can you remember Bernie Madoff? You want to have your money held with a third-party custodian. If you allow the manager to also be the custodian, you're putting yourself at risk because, again, you don't know what what they actually are holding. Look at Bernie Madoff had billions of dollars for decades that basically sat in a checking account and just created statements for his clients to pretend that they were making money. So this number 7 is hugely important. But anyway, this is a really great questions to ask any advisor, and I hope you take the opportunity to download and use it for yourself. And this is the last slide I have on fiduciary, and it's kind of cute. It's not really clear, but it says the desire to act in your client's best interest, and then actually knowing what's in your client's best interest. That's what a fiduciary is. So it's actually knowing about what you're supposed to do and knowing about who you're dealing with. And you put those together, that's what a fiduciary does for the client. And I lied, there's one more shot. I'm a fiduciary, just in case you were wondering, right? So now I want to transition into the next part of this webinar, the retirement puzzle. And the question that everybody asks themselves, whether they're 20 years old or going into retirement at 60, 65, 70, whatever, how much is enough? How much money do I need to make sure that I don't run out of money over the next 20, 25, 30 years or more while I'm in retirement? So we're going to answer that question, and then we're going to go into how to set up a self-directed retirement machine using real estate, using companies like DirectSourceWealth to help fund that retirement. And this is going to be fun. This is the first part we're going to take you through. It's a little bit of humor, but a lot of reality too. This is what I call the ultimate retirement formula. And for those of you who are algebra majors, you'll remember this, y to the first and s and times r. Multiply those and then subtract from y to the second, s times r, and that should equal 0. And basically what this means, you see it down here, you take the years you have to save money, however many years between now and when you're going to stop working. You tell me how many years you're going to do that. You tell me how much you're going to save per year in the rate of return. And then when you retire, when you start spending down this money, you just tell me how many years you're going to spend that money, how much you're going to spend each year, and the rate of return you're going to get on that money while it's still invested as you're spending it down. And at the end of the day, if you did it right, you'll have no money left over, right? That would be ideal. That's the ultimate retirement formula. Problem is, of course, that none of these variables, none of them are known, right? They're all this theory, right? They're all this speculation. So let's take an example here. Let's say I have 20 years to retire. Before I want to retire, I'm saving $24,000 a year. I'm getting an average of 5% per year. I'll have $833,000 by the time I retire. So if I retire and I live for another 20 years and I only spend $24,000 a year and I'm continue to earn 5%, at the end of the day, I'll have no more money. I win, right? The formula worked and I did everything perfect. But again, the reality is none of those things are going to happen. Let's say you live just 2 less years and have, so my Y2 is 18 instead of 20, still spent the same amount of money and had the same rate of return. I would leave $51,000 to my heirs, so leave more, the kids win. Or what if you live longer? What if you live 10 years longer and you had 30 years of retirement, not 20 like you had planned, still spending $24,000 a year? Now all of a sudden you're short, you're out of money. In this example, you actually be out over $300,000. And the follow-up question is that what if you worked less? I mean, if during your working years you weren't able to earn as much, if you weren't able to work as long, or you weren't able to save as much because of expenses, or you didn't get the returns you expected, or you had poor choices or poor decisions in the market. The reality is that planning is an ongoing event that you have to manage and monitor and adjust to as you go through your retirement. So the question is, again, How much is enough? And the answer is it's going to be more than you think. And I'm going to take you through a specific example showing our planning software to you with a hypothetical couple. So this is a younger couple, younger wife and kids that, of course, they're going to have college expenses someday. They're both W-2, so I have Harry and Sally. Remember, Harry met Sally, right? And they're both earning $6,000 a month. So it's a respectable salary. It's about $144,000 a year. And they're going to get salary increases as they continue to work. They're young, and they're going to work until they're 65. That's the plan. So we have theoretically plenty of money. We have continued increases in that income, and we're going to be saving money. What's going to happen to them? Well, how we take a look at that is in the context of something that we created. This is one of our proprietary systems called the 4x4 Financial Independence Plan. The idea of financial independence plan is, first of all, how much money do we need to retire? And retirement is going to have a different definition for us. It's basically when we convert the assets we have to provide the income we need so that work is no longer a requirement, it's an option. That's what we call financial independence. So to do that, we have to look at 4 essential elements. Go over them quickly and I'll drill back down a little bit. So we have income planning, asset protection, estate planning, and tax planning. Income planning is that process of taking the money that you earn, the savings and investments that you have, and investing it in elements that are going to provide the income you need so work is no longer a requirement. Asset protection is about protecting those things you have. It's not just about using entities and other legal means, but there's a lot of different areas in asset protection we want to look at. Estate planning is not just about what you do when you die. It's also about what you do when you're alive, but you're no longer able to make decisions about your finances should something happen to your mental health. And tax planning, of course, taxes being life's single biggest expense, is an ongoing and never-ending thing. And the point of these 4 elements is they work together and interact with each other. And so to focus on just one of them would be shortchanging you. And again, going back to the typical advisor, that's really an asset gatherer, they're not even focusing on income planning. They're focusing on just accumulating assets and helping you grow your wealth and not helping you design a plan that's going to allow you to retire. The second part of this, the 4 sequential steps, we won't get into these in much detail, but basically we want to take a look at everything you have, and we want to make sure that we've got it organized, simplified, and in a manageable format, and that it's doing everything it can for you, that the investments you have are earning what they should, and that you have a strategy that works. Second thing is we want to eliminate debt. We want to get that out of your life, and we want to establish significant cash reserves as well. And then we get back to the idea of saving investing, which takes us right back to income planning. This is the 4x4 financial plan. So let's implement this for our couple, okay? So here's our fact pattern. Carrie and Sally are saving money. They currently each have a 401k with their employer, and they have $75,000, and they're putting in another $500. I don't know if you can see my mouse here. Maybe I should open up this panel here too in case I see little things popping up. We look good. Okay. All right, so they're putting in $500 every month, so $6,000 a year into that retirement plan. So they're doing the right thing, right? They're saving for their retirement, they're making money, and also they have, well, I'm skipping ahead, they have no debt, but here's their expenses, and I say they're in control, because remember they're making $12,000 a month gross before taxes, and they're only spending $4,000 on all their expenses, and this is important. The budget becomes hugely important in terms of what we can do to help make sure that there's money ready and available for retirement when that happens. And this is the slide I was talking about a second ago, and they have no debt, right? So in terms of the 4 steps, we already got step 2 coming in the door accomplished, so they have no debt. And by the way, I'm not talking about real estate debt. I'm talking about debt for credit cards, car loans, basically things, I call it reductive debt. It's things that you buy that depreciate in value or you consume, right? So that debt needs to go away, and they've done that. Now, pause a moment on taxes. When I look at their tax return here, if you look over the far right corner, their federal tax rate is only 15%. They're California, so they have another 9.3% in California taxes, so 24%. And you might say, you know what, that's not bad. Okay, it's not bad. However, if I were to tell you that you could earn 25% return on your investments, you would think I was a genius financial advisor. And the fact of the matter is that deploying tactical tax strategies and taking deductions that you're rightfully allowed to take will give you the exact same rate of return. In other words, if you can take things that you're currently spending with after-tax dollars and find a way to put those into pre-tax dollars, whether you do it through a business, whether you do it through your business or real estate, all those things are going to dramatically increase your rate of return. And you know what? There's no risk. I mean, it's 100% guaranteed. If I can save money on taxes, I'm going to get the equivalent rate of return. So taxes are very big and important part in developing a financial plan. So what happens to our younger couple? Well, they have $150,000 in retirement assets starting today, and at retirement they're going to have over $2,082,000. They should be pretty good, and they are until they're about, what, 83 and 76 years old. They're broke. This is the problem. It's going to take way more money for them to retire than they think. They're short actually about $5 million in the assets they're going to need in order to see them through their retirement. And when we do retirement modeling, by the way, we always want to take the youngest person out to age 100. Why? Well, because they may live that long. There's actually a very good statistical possibility they'll live that long. But you don't want to be designing a plan that has you running out of money at 85 when you're certainly not going to be going back to work. Okay? So here are the choices. These are the fixes for our couple, Harry and Sally. They can work longer or retire later, right? They can save more money or they can earn more on the investments they have. That's it. That's the same three choices that each and every one of us have in fixing that red line, moving it out to age 100. So let's take each one of these choices, these fixes, and see what we could do. First of all, let's work longer. So I have them both working in this example now until they're 80 years old. Now, they're not going to want to do that, and they may not be able to do that, but if they did, we could at least get Harry to 101. Unfortunately, Sally is still going to run out of money at age 94, even worse situation than if she were to run out at 83 or whatever she was before, 76. By the way, because she's so much younger, even if Harry did retire at 65, and we'd have to have Sally work until 85, and if she worked till 85 because she's so much younger, remember that's more years, now we can get her out to age 100, and if Harry lives to be 106, he'll still have money too. So yeah, working longer is really not a good option for these folks. So we're going to take a look at second option, which is save more. Now this is a breakdown of their cash flow in their pre-retirement years, and we're going to look at, say, 2017, and you can see there's their gross income of $12,000 a month. They're putting $1,000 a month into the retirement plan. Their net monthly income after taxes is $8,500 a month. This is their expenses, $4,000 a month, so they have $4,400 left over. Now, the way the software works, at least the first sweep, is it assumes that that $4,400 a month is going to be spent. And you know what? For most people it is. Because if they're not focusing on what they're going to do with all the additional cash flow, that money somehow doesn't make it into saving in retirement. So that becomes really key in terms of fixing these retirements. So let's take a look at this. If we open an account and we just directed $2,800 of that $4,500 that was available each month, so a little more than half of it, now my red line moves out to 100 for Sally and to 107 for Harry. So again, it's just refocusing the attention on the excess cash flow. Now, do they actually really have $4,500 a month? We'll have to find out, because it just depends on how detailed their budget is, but that's what they told us. And if they do, then they have a really easy fix. All we need to do is put that money to work for them. They have plenty of years to do it, and by doing that, they can retire when they want, and they can retire with the income that they need. So, takeaways from this part of the presentation. First of all, create a plan, a financial plan that addresses everything, not just asset accumulation, and certainly, not just the income plan, but the income planning, asset protection, estate planning, and tax planning. use taxes to your advantage. It's a guaranteed rate of return, and for most everybody, you're going to have a very high rate of return because of the high tax rates, especially if you're in one of the high tax states like California. And then the last lesson here is the sooner you start, the better. Harry and Sally were able to save a little over half of their excess monthly income, and just by making that shift, they had plenty of money to make it through retirement. As you get older, it's going to take more and more of that excess cash flow because you have to make up for lost time. So the sooner you start today is better than starting a week from today, okay? And even if you didn't start a year ago, tomorrow is going to be better than a year from tomorrow. So those are your 3 takeaways from this part of the presentation. Couple more things, and then we're going to shift into some ideas about real estate. Traditional retirement plans, your IRA, 401k, and so on, are pretty limited in the amount of money that you're able to contribute. Now, for some people, it's all they have, and it's all they have available to them, and so this is what they're going to have to deal with. Typical 401k, $18,000 to $24,000 a year. If you're a business owner, you might be putting into a profit-sharing plan, or if you have a business owner that's generous, putting into yours. But I would like to let you know that there are much better ways and much larger ways to contribute lots more money into your retirement plans. This plan we call a Super K, and the idea of the Super K is to take the 401k profit sharing plan, adding on something called a cash balance and a 401h, and with using these types of plans, we're able to shelter before tax $250,000 to $500,000, and if you're a married couple, you can double these numbers per year. So the opportunity is out there to save tremendous amounts of money on taxes. You just need to have the tools like Super K to help you do that. And if you're a business owner listening to this presentation, I hope that you'll reach out to us to have a conversation about the Super K yourself. Okay, so last part, and then we're going to shift into real estate. How do you get your money out of your 401k? Well, if this is your option, first of all, 401k loans is a good opportunity. You're allowed to borrow up to $50,000, which has to be 50% of the account balance of your 401k. The interest you pay on your 401k loan is actually money you pay back to yourself, so it's really free money. And really the only downside risk of a 401k loan is if you leave your employer or your employer tells you you need to leave, you got to pay that loan back. So you have to be conscious of that, and that's again why it's important to have cash reserves. IRA rollovers is another way to take money out of your 401k, money that was contributed to your 401k from previous employers and you're rolled into that 401k can be rolled out at any time. All 401k plans allow for in-service non-hardship withdrawals at age 59 and a half, which means you don't pay taxes, you don't pay penalties, you can roll it out. Once you roll it out, now you can make all the choices and decisions. Where do we put it? We put it into liquid, low risk, low volatility tactical managers like I was talking about before. So your money's liquid, that is earning a good rate of return with low risk, and then also allowing you to do self-directed opportunities where you can invest in real estate or other types of investments to enhance your returns that you're making as well, and give you some more control. So with that, now I'm going to shift into how to set up a self-directed retirement machine. And we're going to look at, I'm going to shift to a spreadsheet, and bear with me here, folks. And I'm going to put this up here now. If there's any reason, Dave, you can't see this, I just need to know, okay? But hopefully you can see this spreadsheet. Now, this is an analysis that we do. We're good. All right, thanks, Dave. I appreciate that. So this is an analysis we do for our clients, and this is actually a real analysis for one of our actual clients in Colorado. We deal with clients all over the country, and most of my clients, as I said before, I work with business owners, homeowners, and real estate investors. So most of my clients own real estate. Most of my clients own a lot of real estate. So this particular client owns 4 pieces of income property as well as their primary residence. And so we want to drill down on these properties to find out if they're good investments, because just because you own them today doesn't mean you should own them tomorrow, right? So we capture all this information, and now I'm going to take them through what I call the transformation. So let's take a look and analyze these numbers in summaries here. okay? So current basic data, they have a home, primary residence that's worth $400,000, and they have a $237,000 mortgage against it. They have $125,000 of cash in the bank, checking accounts, savings accounts, whatever. And I'm going to be generous, pretend it's getting a 2% rate of return, just for this illustration's sake. They also have another $250,000 in their 401ks, and again, I'll be generous and say they're getting a 5% return on that. Their investment properties, they have $715,000 of income properties. It's providing about $4,200 a month in income. That's the gross rent. They have mortgages, the average interest rate, 5.68%, and the average term right now is 25 years. So they have equity of $333,549. Now, when we're doing analysis on rental properties, we want to make sure that, again, we have liquid reserves above and beyond what you would have to have if you just, well, if you didn't. And so the way I do it is I use a benchmark of 3 months of rent. With 4 properties, 3 months rent, we're talking about $12,000. The possibility, the likelihood of having all of his properties being vacant for 3 months is probably 0. So by doing 3 months, for all the properties, that's going to be plenty of money. But what it tells me is for those properties, he's got equity of $333,000 and then another $12,000 he needs to set aside in reserve. So what he has tied up, or should have tied up, on those properties is the equity plus the cash reserves comes to $346,000. Now, when we analyze the properties, by the way, I have some adjustments in here. I'm going to leave at 0. This is for appreciation. I'll explain why in a moment. But we want to break down the land values versus the improvements, so we can determine how much the appreciation is. Real estate, especially in California, frankly, any of the high valued markets, we see land values where they might be 80, even 90% of the value of the property, and of course that significantly reduces the depreciation deduction you're going to get. So in this example, I'm going to give him 60/40. There's his rent, and now I'm going to start taking out for expenses. Now again, generally I can take these right off at my client's tax returns, but as a benchmark, I always want to have at least 25% of the gross rent set aside for vacancy, maintenance, and management. Now, why 25%? Well, that gives me money to allow for the property to be vacant 1 month a year. We don't want it to be, right? But we're modeling here, and so we want to plan for the worst and hope for the best, and know we're going to end up somewhere in between. So I'll set aside 25% for that. I'll plug in what I need for property taxes, for homeowners insurance, homeowners dues if we have homeowners dues, and so the total expenses on these properties comes to $2,000. My rent is $4,200, so my net operating income is $2,134. That's an important number because from that I'll subtract my mortgage expenses, and now I'm going to have my net income per month, which is a negative $235. So a negative $235, it's funny. Often I'll have people tell me, yeah, my properties are cash flowing. I'm getting, almost, a break even. Well, this is what they mean by cash flowing. They're going to put a 0 in vacancy, a 0 in maintenance, a 0 in management. They're going to take their taxes and insurance, and they're going to say my properties are tax flowing $814 a month. But it's just not true. Because they're going to have vacancy, they're going to have maintenance, and if they're not doing management themselves, they're going to pay management fees, and if they are doing it themselves, their time is worth something as well. So in this real life example, I look at these properties, and this is the evaluation, the summary of all their properties. And you can see they fail, pass, fail. So let me walk you through these. First one's called the RV factor, rent to value factor. It's a real simple, quick and dirty evaluation of a property, whether it's something you want to keep or not. And basically you take the monthly rent and divide it into the value of the property. And it should be 0.7 or higher. So if I have a $100,000 property, I should rent for $700. So in this case, my RV factor is under 0.59%, so it fails. Now, the RV factor sometimes can be offset with appreciation, right? In other words, you can make up for a poor cash flow situation by seeing the home value go up, but we're buying properties for cash flow, and we want to use appreciation as icing on the cake, so it fails. Debt coverage ratio is one that you can fix. Debt coverage ratio, we want to see a number. Debt coverage ratio, by the way, is the amount of income you have over the debt. right? And we want to see a number that is generally about 125% of the debt, and then cap rate. Cap rate is pretty simple concept. If I own these properties free and clear, what would my rate of return be? So I take my, again, gross rents minus all my expenses, except for a mortgage, and divide that by what I paid for the property, and I'd be getting a 3.52%. Real estate needs to get higher rates of return on that cap rate. Why is that? Well, because although real estate is an amazing investment opportunity, it's also one of the most illiquid assets you could look for. You can't sell them necessarily when you want to. When you're going to sell them, it's going to cost you money. So you need to get higher rates of return to make up for that lack of liquidity. So let's put this all together. Currently, we have a cash flow annually of a negative $2,800 a year. We have principal reduction, however, of $6,154 because of the interest rates they're paying and the types of loans they have. There is a cash flow coming back to them. They don't get to see it, they can't spend it, but it is coming back to them. And that, again, the cash on cash rate of return is providing them 1.8%. They are getting depreciation, that's providing another 3%, and again, we left the appreciation at 0. So we put this all together, this is what we have currently. We have $346,000 tied up. We're getting a negative cash on cash return of $2,800 a year. We're making up for that with the principal reduction, with the depreciation deduction. So my net rate of return on this current portfolio of real estate is $13,735 or 4% a year, okay? Okay, it's okay, but can we do better? I believe we can, so let's see what we can do. All right, so this is what I like to show as the transformation. Remember, we had $715,000 worth of real estate. Let's say you sold it all. This is hypothetical. I'm not saying I would recommend this. I'm just saying this is what you could do. And let's say you paid 8% in selling costs, real estate commissions, title insurance, whatever. So it cost you $57,000 to get rid of all those properties. You paid off all the loans. You're still left with $276,000 worth of equity that we've now freed up. Now, instead of having that 0.59 RV factor, what if we bought properties that cash flow better? And just use an RV factor of 1. By the way, if I have a 1% RV factor, that means my rent's going to be what? $2,763.49 a month, right? And if I took that equity and I used a 25% of it, in other words, I'm going to leverage it up. I'm not going to pay cash for these properties. I'm going to leverage them up. I would be able to purchase $855,000 worth of real estate that with my 1% RV factor is going to provide me $8,500 of rental income in gross. So the question is, how do I do that? Well, let's walk you through the model. So I put 25% down on my $855,000. I get $641,000 of loans. I'm using 4.5% as the interest rate. 30 years. There's my mortgage payment of $3,250. I had to pay points to get those loans with 25%. I'm going to pay 1 3/4 points. I'll throw in some additional money for acquisition costs. Maybe I have some rehab costs. We model all these different factors in. So altogether, I needed $250,692 with down payments, closing costs to get into this property. Then again, I'm going to set aside 3 months rent. I want to set aside part of my money as cash reserves because I'm acquiring more properties, and if they go vacant, I don't want to be, wondering where that income is going to come from to support the debt. So I've tied up my $276,349. This is going to sit in my bank account. This is going to sit in the equity in the real estate. This is going to get the new properties. But altogether, I'll use up every penny. Now what happens? Use the same model. I'm going to switch to different markets, by the way. I switch now to a market where I have lower land costs and higher building, which is more ideal. These are more your non-urban markets, your middle America, if you will. And by doing that, and using the same depreciation rate, now I'm going to have another $24,880 of depreciation to use to offset my income. So here's my rent. Here's the numbers. Here's my rent. Here's my 25% going out in vacancy, maintenance, and management, same property taxes, same insurance. I have total expenses of $3,550 a month. But I have rental income now of $8,500 a month. So my net operating income is a positive $5,203. By the way, if I played the game, and I went back to 0, 0, 0, right? No maintenance, no management fee. I have positive net income of $7,300. Not going to do that. We're going to model this out, planning for the worst, hoping for the best. Take away my mortgage payment, so now my net monthly income is at almost $2,000 a month. Just by taking what he has today, getting rid of it, paying all the expenses to get rid of it, and freeing up that equity and redeploying it in a better investment model. Now, all of my investments pass the test. Our V factor is 1%, of course. My debt coverage ratio is 1.6. My cap rate is 7.09. All tests passed, but let's see what it looks like in real numbers. I'm going to scroll all the way down to the bottom here where we can see it all at once. So my $276,000 is providing an 8.5% rate of return cash flow, another 3.7% in principal reduction, and $24,880 in depreciation. This is an important number. Why is that? Because basically 100% of this $23,000 is going to be income tax free. And that doesn't have any restrictions on how much you earn. If you're earning $100,000, $200,000, or you're Donald Trump earning $100 million, $200 million, $1 billion a year, if you have depreciation to offset the income, you're not going to pay a penny of tax on that money. So really, I'm showing a 21.2% rate of return, but net after tax or before tax, it's even a higher rate of return. Total $58,000 by repositioning the equity. Now look at the change, right, from this to the previous. I have a 931% increase in my cash flow, a 68% increase in my principal reduction, 139% on the depreciation, altogether $44,000 a year more than I was making by just redeploying the assets you have into better investment options. Now, let's just take this one step further, and then we're going to wrap up and open it up to questions. So we have a home worth $430,000 with a $237,000 mortgage on it, which means he has equity of $162,000. What if we refinance that home, 75% loan to value? That would free up another $62,000. I'd have a new loan of $300,000, and I'd have to pay 4% interest, say, on that loan today. So the net increase in the cash payment over my current mortgage payment is $296 a month, or $3,500 a year. But if I was investing that $62,000 at that same 21% rate of return, I'd be earning $13,000 on that money. So I pay $3,500, and I'm also getting a return of principal on that mortgage payment. So really, I'm getting $10,000 income per year from the equity that's sitting in the house, earning them nothing. Again, not recommending people do this, just saying it's a possibility. Now, that $125,000 in investments, I want them to have significant reserves, so we're going to lock out $100,000 of that. I still have, I'll say I'll earn 3% on that money, but I still have $25,000 then I could redeploy at 21%, earn another $5,300 on that. Then I have my 401k. Take that loan for $50,000 at 21%. I'm going to get another $10,000. Now watch this carefully. So I'm going to pay this loan back. I'm saying 0% interest again because even though I'll be paying interest on this loan, the interest is going right back to me. But I'm going to pay it back in 5 years, so I have a cash flow of $833 a month or over 12 months, which is $10,000 a year. Okay. And by the way, who's paying that loan? If you're invested in real estate, your tenants are. They're repaying that loan for you. So I have a net income of $713, but really it's after 5 years that $10,000 is paid back, and you're going to have $10,613 a year of income forever because this money is being repaid in a 5-year time frame. So let's put this all together. Same net worth, $870,000, but now instead of having $32,000 as a return on investment, I've got it up to $85,000. Instead of having 3.7% average rate of return, I have 9.8%. And take this out over some time. Over 5 years, this represents $68,000 and $137,000 versus for over 5 years, $426,000 and $852,000. And all we did was take what they have, analyze it to see if there could be something that could be done better, and this is part of the optimization process, and these are the kinds of results you could have. So Dave, that's the end of my presentation, and I'm going to, I guess, open it or turn it back over to you so we can talk a little bit how Direct Source Wealth would work with this type of strategy and answer any questions people have.
Thank you, Randy. Begs a couple of questions here real quick before I open it up. And one of the main scenarios with direct source wealth style investments is that, first of all, we focus very strongly on multifamily. So vacancy is less of a factor than it is in a single family environment. And second of all, we have a combination of note lending and equity investments. Note lending is strictly the passive cash flow model, where equity investments often offer cash flow, depreciation, and equity growth without necessarily having to be a direct owner. I shouldn't say be direct owner, you are direct owner partners, but without necessarily having to manage a property that may or may not have all of the other risks associated with it in terms of the management, vacancy risk, and proper tracking of all of those other expenses that come alongside of actively managing a property. Randy, how would you position a DSW style investment in place of or alongside of an active ownership environment, very much like what you just presented?
That's a great question, and thank you for sharing those details. So let's look at this a couple different ways. Let's go back to the transfer potential, okay? And let's take a look at these apartment rentals, David, and give me, what would be applicable for vacancy maintenance and management in terms of percentages with your properties.
Well, let's use our recent closing in Palm Air as an example.
Okay.
The vacancy rate when we acquired it was finalized at 95%, occupied when we first acquired it. It's a 182 unit complex, I think. So, but in terms of managing the vacancy rate, it's not as much of a concern for our equity investors because that's part of our PPM and pro forma planning aspects, is that we know it's going to take a hit up front, and then with the proper kinds of tenants, it gets better. Direct maintenance is not part of their issue. Management's not part of their issue. Their personal taxes would be, but the insurance on the property and HOAs are eliminated. So the vacancy rate doesn't particularly affect the cash flow that they may receive, which on Palm Air is projected to start in August or September, and it should come out of the gate at about a 10% annualized cash flow.
Okay.
We're also performing a cost segregation analysis on that property, so we plan to radically accelerate the depreciation that's possible on that property, and whether or not we sell the property or refinance it, short or long term, at some point there'll be a cash out plan where the investors are able to take advantage of the equity gain and then leverage the return of capital into an additional investment.
Well, yeah, and you said a couple things in there, David. So I stopped changing the numbers because obviously what you're talking about is radically different than direct ownership of these types of properties. The idea, first of all, is hit on one of the things you talked about, the accelerated depreciation, which is huge because you want to take depreciation today. Dollars today are worth more than dollars 5 or 10 or 15 years from today. So taking something out over 27.5 years versus using the accelerated depreciation is going to give you more deductions today, and those deductions are worth more to you today. So that's huge. And then by having a professional company like yourself involved in managing the property, taking care of all aspects, what would you, net, what would an investor, rate of return be on an apartment complex like that? We can plug that number in.
We're projecting a 10% annualized cash flow, ramping up to somewhere in the teens once the property is stabilized.
Okay, so 10% cash flow, right?
Correct.
All right, so let's do some quick math here. Some Excel wonder, right? So we're going to change this to 10%, and we're going to do that. By changing this. Okay, so let's see what that does. This is the same person now. They sold the property, their other properties. They've gone into your investment. We'll use the 10% cash-on-cash rate of return. Do they get a benefit of the principal reduction too, David, in your model?
Not exactly sure how that would be calculated, but no, they're not paying down the mortgage in my model because they're not. That's all part of the original package, and it's part of what we manage for them. So, they wouldn't be reducing their mortgage, but we are reducing the mortgage along the way. So
at the end of the day, you sell the properties, and do they get a return of equity?
Yes, sir.
Yeah, so that they will get a portion of that. So let's just roll with these numbers. This takes it to a 22.7% rate of return. Again, markedly better than the properties that this particular person's in. And the point is that real estate, because it has these multiple income streams, if you will, cash flow, principal reduction, depreciation, and appreciation. I imagine these properties, when you take them over, you're also going in, making improvements, and you're able to increase the rents as a result of that too?
Yeah, there's a number of optimization factors. Increasing the rents part of it. Providing a more stable occupancy is part of it. Ultimately, the altruistic part of it is creating nicer communities for people to live in and making a better world for people. Financially, for our investors, it's getting them from where they are now to a point of financial freedom, where that passive income exceeds whatever expenses they have, like we talked about at the beginning of the meeting. And that's an ultimate goal, because at that point, it's about freedom, and it's about living the life that they choose, not the life they have to.
Exactly, and again, you keyed on a big point. When you buy single-family residences, the appreciation is always a function of the market. The market drives the prices up, or the market can take the prices down. When you manage apartments, everything's about cap rates. And so if you can have higher retention, get slightly higher rents, if you can manage your expenses, that's going to drive the cap rate up, and that's going to create a multiplier in the value of the property that you create all by yourself, irrespective of the market, which is huge opportunity.
Let me expand on that a little bit further and ask you a hypothetical question of what if along the way, not just because of good management and operating practices and accounting services, but what if along the way we were able to increase the amount of NOI year over year in a consistent and predictable fashion, that in my mind would create an additional equity growth possible when you multiply it times the cap rate to come up with the value of the property.
Yeah, and with apartments, that's one of the levers you get to play with, where you don't get to do that with single-family residences, 1 to 4. So basically, you're saying if you can systematically increase rent over time, that's going to leverage up the value of that rent increase as well, and provide, again, more value. So once the property liquidates, your shareholders will get, the benefit of that. The idea here is that as a financial planner, you want to look at stocks, bonds, and mutual funds because they do provide liquidity. It's an option. You just have to manage them properly. You want to have cash in the bank because you need to have dry powder for rainy days, or you need to have dry powder for when opportunities present themselves. But when you start incorporating strategies of using real estate, you can really get some powerful rates of return and tax advantages that go along with those. And for those reasons, real estate's one of the best investments you can find.
So with that, a program that's particular to Direct Source Wealth, we call it the DREAM program. It stands for Direct Revenue Earnings Acceleration Model. And I'm not going to go directly into it right now, but in addition to raising the rents, it provides additional multiple streams of income for a property unlike a strict buy and hold or increase the rent scenario. So it's one of the things Direct Source Wealth does a little bit different in the market. It's one of the things that your consultant would be able to get in depth with, when you're able to call in. I do have couple of quick questions on here.
Sure.
I'm going to throw it to you real quick, and then we're going to wrap it up. The first one comes from Mark. Mark, thanks for chiming in. I don't understand needing $6 to $7 million to retire at 65. I think he's referring to probably an earlier part of your presentation.
Yeah, I don't understand it either. Now let me take you back to that. Why you need so much money? The reason is twofold. The first one, go back here. The first one is right here. You see the current monthly expense of $4,000? You see that, David?
Yes.
Okay, good. All right, so I want to make sure that this changed. So that $4,000 in my model is increasing by 3.26% a year. It's not a lot, but it's a statistical norm we can use to model these things out. We can use any number you want. But you can see by the time this younger couple retires, that $4,000 will require $11,000, almost 3 times as much money they'll have to spend to have the same buying power for the things that they're purchasing today. And so what happens is you take that $4,000 out to age 100, and it could, and I have to look at the number, but it could be $22,000. And so if you're a month, right? And so if you start taking out these big numbers, these big numbers of expenses as you go forward in your retirement years, then they just eat away at the value of your investments unless you have investments that can keep up with them, which is, again, one of the reasons real estate is such a good play for from the leverage perspective, because guess what? Rents keep up with inflation. So income will keep up with inflation, and that will help you offset the expenses. That's why you need $5 million, because of the expense going up in 20, 30, 40 years down the road.
Mark, I hope that worked for you. If not, let's connect in the near future, and we can go over that again. Couple more quick questions. One, I'm getting a number of requests for the worksheet and the handouts. If you cannot see them on the side of your screen on the control panel, by all means, please email Diana at directsourcewealth.com with a request, and she'll reply right away with a copy of those handouts. The last major question, what type of equity do you have in place to pay off all those loans if, 1, you lose your job, 2, the economy takes a plunge, or 3, the bank calls in the loans? Is it strictly your $100,000 in cash? Question mark. From Camilla. Thank you, Camilla.
Yeah. So let's work it backwards. First of all, banks will never call in a loan unless you stop making your mortgage payment. You know, people didn't lose their home in the recession. They for whatever reason gave it up. They could have lost their job, and they couldn't have afforded the cash flow. But the bank can't call a loan as long as you're making a mortgage payment. It's not going to happen. The idea of having that, and I hit on this a couple times, and maybe I wasn't strong enough with it, but the idea is that when you acquire rental property, you want to set aside 3 months of cash reserves, rent, for each property you acquire, and I used $100,000 just to have round numbers, but we look at the properties you're buying, we look at the rent you're collecting, and we want to see that you have 3 months of cash reserve for each of those properties. And in this example, he had 4 properties, so you think about it, I'd have 12 months of cash reserves. That 1 property would be empty a year, not going to happen. That 4 properties would be empty for 3 months in a row, not going to happen either. So yeah, it's enough to protect yourself from those types of downturns. And again, if there's a severe problem like the house burned down or flood, or you'll have insurance for those types of things. But what you really want to insure yourself for with the cash reserves is vacancy.
Thanks again. Let's go ahead and wrap it up. Randy, you want to give your contact information real quick?
I do. So I have this slide right now. I'd like to encourage everybody that's listening to this to take advantage. This is a free offer for something we created to give everybody some good, valuable information and a taste of how we work. By going to our website, lifetimeparadigm.com/toolkit, you put in your name and email address, and what you're going to get are 4 free books that you'll be able to download. One's Bad Advisors is an awesome book. It is a real eye-opener, kind of like a Tony Robbins book, about the things you need to understand about my business and how to spot bad advisors, frankly. But they're all really good books, so you get those for free. And then you're also going to get 2 analyses, the DOS analysis, the POM analysis, which will explain more about that on the website. Plus, you're going to be able to have a one-on-one meeting with me for 20 minutes to talk about anything. We can talk about the analyses, we can talk about your real estate investments, we can talk about anything you want financially. Normally I bill my time out at $265 an hour, so that's worth 100-some bucks and 20 minutes of my time for free. So I'll take advantage of that. lifetimeparadigm.com/toolkit.
Great. To reiterate, anyone needs a copy of the handouts, please email Diana at directsourcewealth.com. And if you have questions specific to DSW investments or putting this all together in a passive investing arena, which is what Direct Source Wealth is specializing in, please hop on our website, directsourcewealth.com, or feel free to email me, Dave, at directsourcewealth.com, and either I'll respond personally or I'll make sure one of my consultants is able to get back with you. Standard return time on that's 24 hours. I want to take just a moment, thank Randy one last time, and thank you all for being here and being so attentive. This is the first in a series of educational webinars that we plan to do approximately every other week. Please be on the lookout for additional invitations. And I believe we're going to be renaming this as we go forward into a Maximizing Your Wealth seminar, educational seminar stream. So please keep an eye out for additional emails, and look forward to connecting with anyone and everyone to make sure you get any questions answered. Thanks again. Diana, would you go ahead and